In this video, we're going to look at the Sacramento rental market for multifamily properties. As usual, we're going to open our filters, and you will be able to see that we are excluding corporate, military, senior, and vacation. Vacation is going to be important because we do have the South Lake Tahoe area inside this MSA, which goes all the way to the Nevada state line. We are also only looking at market and market affordable. Now, caveat here, because we are doing this MSA, that these properties that are up in the mountains, so if you're not familiar, right outside Sacramento, you start to go up the Sierra Nevadas on I-80, over I-80, and down into the Reno and Carson City area, as well as Lake Tahoe. Here's Reno here. You can see I-80 is right here. Okay, here's I-80. So South Lake Tahoe is actually up 50, I believe. But these properties up in the mountains are going to be completely different than these properties in the rest of the MSA. So we have to take that into consideration when looking at this data. All right, but let's go see what the data shows us. So we'll jump into analytics. We can see here from the supply snapshot that we have a total of 4,188 properties, totaling 143,444 units. There are 4,800 plus units under construction, and it looks like there has been an exit in the Class A and B and C markets in combination. So we'll look at the Class A, Class B, Class C individually, but altogether, people are leaving the rental market instead of absorbing the units that have delivered. And I don't know what those units have yet. I've not looked at this, but we can definitely see that this absorption is definitely being felt in the vacancy, because vacancy was 3.9% a year ago, and now it is down to, or is up to 6.1%, causing the occupancy to go down. We do see a very small trend in rent increases on a year-over-year basis. We'll see what it looks like quarter over quarter. If we look at the long-term occupancy average, we can see that the long-term occupancy average is 94.41, and that the market is currently at 93.88. So under the line on the market cycle chart, we are below it over on either phase 3 or phase 4. I'd say we're probably teetering right on the edge of it, going from phase 3 oversupply to phase 4 recession, but we're just teetering right on that line. So let's go see what the data shows us. So here are all the Class A, B, and C properties in the Sacramento metro statistical area. Again, we will not be looking at asking rents because we don't care what they're asking for. We want to know what they actually get for rent, and that is the effective rent. That's the amount collected. In the first quarter of 2022, it was at 1736, went up to 1763, and at that point, it started trending downward. And that absorption that we saw on the snapshot can definitely be an indication of what we're seeing here with the downward trend in rents. We're actually lower in the fourth quarter than we were in the first quarter, but we'll see when we look at each individual asset class, A, B, and C, how each of those are affected. Let's go see what the supply side looks like with deliveries, construction, and absorption. We can see that we delivered 409 in the first quarter and an additional 194. So 409 vacant units were delivered to the market, and an additional 194 units went vacant as people were not absorbing this market. More people left than came in. Then we had another 298 go vacant as it was delivered, and another 282 also left. So this market is definitely going backwards. Now, once again, we don't really know if that's happening up near the state line in the mountains or if that's happening down in the Sacramento area. Those are two very distinct different areas, and I'm very surprised that the South Tahoe area is even encompassed in this MSA. It probably, even though it's across the state, should be encompassed in the Reno Lake Tahoe area on the Nevada side. But I guess because we got that state line, we have to draw that line somehow. So I don't believe that this would be the case up in the mountains. I believe it would be more a case of what we're seeing in the rest of the country down in the Sacramento area. inside the valley itself, in the Central Valley, which is the San Joaquin Valley. For those that don't know, it is the largest valley in the entire United States. I think what we're seeing here is a trend that we've seen every place else, in that the rents are just too expensive now, and people are starting to double and triple up, or possibility they could have moved into single-family homes. But at these rental rates, I doubt that's the case, considering the single-family prices that are in California. All right. And I know you're looking at this and saying, wow, only $1,700 rents. They're more expensive than that in Texas. Sacramento is more of a blue-collar community. Even though it is the capital of California, it is more blue-collar than it is anything else. So that's why the rents are lower. That encompasses the entire Central Valley. That is the agriculture capital of the United States, is that San Joaquin Valley, and Sacramento is kind of towards the north end of that. So we can see we still have 4,873 left to deliver, and we can't even absorb what's delivered already, which appears to be about 2,100 units. So not a good sign for the overall MSA. Let's go look at the Class A properties. So here's our Class A data. Once again, we will be looking at effective rent, not asking rent. We have 92 properties that are considered Class A in this market, totaling 17,426 units. If we look at our rent trend, we started at $22.85, went up to $23.35, and then the rents started trending down. It actually went lower in the third quarter than it was in the first quarter, which is the first time I've seen that in all the markets that I've looked at over the last 3 weeks. There's been well over 30 markets. This is the first time I've seen the third quarter trend lower than the first quarter. That's not a good sign, folks. And then even lower in the fourth quarter, showing a year-over-year decline of negative 3.8. Okay, there's only been 2 other markets where I've seen a negative year-over-year decline. Now, we did not see that in the overall, so either the C or the B is holding this market up. But for the A's, they have definitely hit their limit. If we come over and look at deliveries, so it looks like they're delivering more B's than they are A's. We can see that about half. So there's about 1,000 units here. So about half are B's and half are A's. So in the A's, we delivered about 1,000 units, but we only absorbed, at least there was some absorption. You only absorbed, about 450 total units. So not a good sign whatsoever. 20 to 25% absorption rate will send you down the rent decline train for sure, as we've seen in all the rest of the markets. Let's go take a look at the Class Bs. Although I want to say that I would have expected to see more decline in absorption than this for how fast the rents went down. So little strange that the rents declined as much as they did with some absorption. So I did want to add that. Let's go look at the Bs. So here's our Class B data. We have 553 total properties totaling 50,247 units. We are looking at effective rent. We started the year at $18.97, went up to $19.22, and then down to $18.96, and then $18.69. We're actually lower year over year, fourth quarter 21 to fourth quarter 22, giving us that negative growth. So once again, we have a downward trend in rents, a declining rent situation, probably due to deliveries and absorption. So let's go look and see what that looks like. So we can see here we got about 1,000, a little more than 1,000, 1,100 units have delivered. So 50-50 again between the A's and B's. These are the B's, and look at the B's. So the B's are completely negative. Okay, so definitely shows, this is what I expected to see for the A's with the type of, or how quick the rents were going down. If we look at our rental prices today, let's go back, look at effective rent. Yeah, we're at $1,800. It was $2,300, $500 difference from the A's and B's. I think the A's just hit an affordability problem and said, look, we're not going to pay these rents anymore. And they had to decrease those rents. But even in the B's are saying, yeah, nope, don't want to play. We're going to double, triple up, maybe go down to the C's. I don't know. We'll see what the C's look like. But since the A's only absorbed about 20% of what they delivered, then we know that the absorption did not come from the B's. They came organically. So where did the B's go? Did they go to the C's? Or did they double and triple up? Well, let's take a look at the C's and C. So here's our Class C data. There are 3,315 Class C properties in the market, totaling 75,502 units. If we look at our effective rent, we see that we started at $1,442 in quarter one, went up to $1,465, went up to $1,471, and now have started to trend slightly down. Okay. If we look at the vacancy did increase each quarter, which tells me we had negative absorption each quarter. So why did we grow rents in second quarter and third quarter with this trending vacancy that we see? Now, the vacancy is still under the long-term occupancy average, so we're still seeing demand according to the vacancy number. But when vacancy is increasing, occupancy is decreasing, there should not be an upward trend in rents. We should see a downward trend. That's how demand supply works. Let's look at our absorption. Shouldn't be any deliveries because these are C properties. And as I suspected, because of that vacancy increasing, occupancy decreasing, they are losing people every single quarter, albeit a small amount. Okay, only 0.2%, 0.4%, 0.5, 0.5. A small amount compared to, if you remember, there are 75,000 units in this market. So is 346 going to put a big dent in it? Not necessarily, but it is going to increase your vacancy. So they're not going to the B's because the B's look like this. They're not going to the A's because you don't go from paying $1,400 a month in rent to paying $2,300 a month in rent. So they are doubling and tripling up. They have said we can no longer afford this. This is all we can stand. We can't stand no more. All right. So we can see that Sacramento is definitely teetering right on the long-term occupancy average. And probably next quarter, we can say that we could officially plot them into the recession cycle for multifamily properties in the Sacramento metro statistical area. I wouldn't quite put them there yet. I'd put them right on that long-term occupancy average line, teetering between both oversupply and recession. So that is the Sacramento metro statistical area. Tomorrow, we are going to look at Tampa, Florida. I will talk to you guys tomorrow.